get started. So first of all, thank you for joining another webinar into the Blocks series in which we try to cover hot topics at the intersection of machine learning and data science. Today, I'm doing this from the mainnet conference, so sorry about the hotel background. Hopefully, it won't be an issue. Today, we're going to be talking about the sort of the peculiarities, some of the unique characteristics of quantitative strategies for crypto. This is a session that I presented recently at the Quant in Data Science and Trading conference, and it was very well received. So we repurposed it for this webinar. We think there are some interesting ideas there that are worth discussing. So the agenda is super simple. So we're going to talk about unique characteristics of quant in crypto, some of the unique sources of alphas for quant strategies in crypto. A section about DeFi, sort of from an angle of high frequency trading, is something that we have covered in a couple of webinars before. Some inefficiencies in the crypto market, a little bit about quant and NFTs, and also why most crypto quant strategies fail. What are some of the biggest challenges of building quant strategies in crypto? And then finally, a little bit of a section about some new ideas, some cutting edge ideas about quant strategies combining deep learning and crypto. So as you can see, it's a ton of ground to cover. So I'm gonna go super fast. But then also, if you have any questions during this presentation, feel free to use the Q&A and the Q&A panel, and then we'll be monitoring for those. Today I'm using a single monitor because, as I said, I'm traveling, but I'll do my best to stop multiple times and answer those questions. Before that, we would like to give you a very quick update and IntoTheBlock. Both our analytics and quant divisions are posting a very strong quarter in the Q3. Since the last webinar 3 weeks ago, we have done a few new customer launches. For instance, the TapZ mobile app for crypto already incorporated some analytics and indicators powered by IntoTheBlock. So did the Blockonomist portal, as well as the Trade FADA portal as well. And we have more and more exciting launches. A few weeks ago, we announced CoinDesk, but I think we covered that one in the previous webinar. We're also, before concluding this quarter, we have a few things that we're releasing that are super interesting. We're gonna do a release about Algorand analytics, so fully support for the Algorand blockchain, and that's exciting. It's actually gonna be the topic of the next webinar. We just released a number of indicators for ETH2 that are fairly unique, and then we're gonna be launching some new things. We have a very large catalog of DeFi analytics. We're gonna be incorporating a few new protocols in that area. So those releases, you should see updates before the end of the quarter. So with that, let's start with the session today about quant strategies for crypto. The first thing to understand when thinking about quantitative strategies for crypto assets is what makes it unique. And there are many factors that make quant strategies for crypto different from traditional capital markets, but most of them could be boiled down to four fundamental elements, four fundamental vectors. One is the fact that in crypto we have sources of alphas that are non-conventional and they have no equivalent in traditional capital markets. Also, the fact that we have programmable financial primitives such as lending, market making, and things like that, which is sort of a concept that, again, in traditional financial instruments doesn't exist. The inefficiencies in crypto are unique for trading the market with quant strategies in this day and age, and also the fact that there are new types of digital assets such as NFTs and all that trade based on patterns that are really not corresponding with the macro crypto market. So I think most of the uniqueness of crypto from the quant perspective could be boiled down to one of those four factors. So let's break it down one by one. So unique sources of alpha. This is a pretty trivial one. Blockchain datasets is a source of alpha in my session on mainnet yesterday, in one of my sessions, we were discussing this, how much alpha there is in blockchain data sets, and whether that's debatable. There is no question that there is some, right? So blockchain data sets definitely represent a very unique source of alpha from the standpoint of quantitative behavior. If you want to see some examples of indicators of features that could be that could lead to alpha discovery in quant strategies for crypto, for instance, financial analysis of wallets. This is an analysis that we call the in and out of the money. In this case for Bitcoin, that gives you an idea of profitability of different wallets that are in close proximity to the current price. So it gives you an idea if Bitcoin move up or down, how much resistance or support, how much volume is going to be in play. And you can see this type of feature being an input as a predictive model for reacting to a specific price movement. So a traditional sort of momentum type, a feature for a momentum type strategies. Then a classic one here that IntoTheBlock, but also other analytics providers offer is this idea of monitoring inflows and outflows out of specific wallets, in this case, exchanges. So if you're able to identify, to classify a specific, to label a specific addresses, associate them with a party, in this case, an exchange, you can monitor how much capital is moving in and out, and that could be a signal for a specific market condition. So a lot of money flowing into an exchange could be a signal of increased volume or increased selling activity, and it could be interpreted as a bear sign. The same way money flowing out of an exchange could be moving into stable coins and taking a pause in the market. So this is the type of thing that you can do with blockchain data sets that you cannot do with any other traditional data set. The same with miners, right? Miners are a very important component of the crypto ecosystem. So having this idea of how much capital is flowing in and out of mining pools is a very interesting metric to keep track of, that could be conducive to a specific alpha in different strategies. Another one that we pay attention to is keeping track of addresses holding crypto, in this case Bitcoin, for a specific amount of time. So you can see long-term holders, so the addresses that have been holding Bitcoin, let's say 1 to 2 years, that they start selling, and that could give you an indication of a specific activity throughout segments of the market, and it's something that could have predictive capability. And there are many more of this, but this gives you an idea of the type of alpha indicators that you can compute using blockchain data sets. Now, there is no magic formula here, right? Like you cannot take one indicator and maybe you could, but we don't think it's that trivial, right? And derive a predictive model from it. Typically, the quant strategies use many inputs, and some of these inputs could be these features computed from blockchain data sets. But without a doubt, blockchain data sets are a source of alpha and could provide very robust features for quantitative strategies. The second factor that I enumerated at the beginning is this idea of new financial primitive, right? With traditional financial instruments, we're dealing with the same set of primitives that are mostly static, right? You're dealing with lending, market making in an infrastructure that has been established for decades and hasn't changed that much. In the case of crypto, with platforms such as, with trends such as DeFi, we are moving towards a world in which all these primitives are automated in the form of a smart contract. So you have things such as lending, market making, capital formation, asset composition, insurance derivative, and many more that are programmable, composable, automatable. What that gives us is the idea of building a type of a strategy that incorporate those primitives as the first-class citizens. That is the type of strategies that we cannot compose using simple traditional financial vehicles. So specifically, DeFi is playing. We have this theory that DeFi is sort of the next frontier for high-frequency trading strategies. So this idea that everything is on chain, you're seeing what your competition is doing, your competition is seeing what you're doing, and you have a first level access to the underlying financial primitive is what it sort of encompasses all sort of the key characteristics of HFT, of high frequency trading, in a more open sort of setting. In general, there are four factors that should be considered when thinking about HFT strategies for DeFi. One of them is the block speed factor, the fact that HFT, high frequency in crypto, is not high frequency in traditional capital markets. You're not talking about microseconds or nanoseconds execution times. You're limited by the block factor. So typically you're talking on a single digit seconds type of thing, which is considered medium frequency for in most quant circles. Then there is also this, what we call the trade transparency factor, is this idea that you can see what your competition is doing, your competition can see what you're doing. So it creates a different gaming dynamic than in traditional HFT, on which you have certain level, your competition cannot quite see the logic for a specific trade, and you cannot see theirs. So there is more opacity. In that sense, here is everything is visible, and there are pros and cons to that. There is also the fact that transactions in HFT DeFi have a cost. So you need to pay for gas or for gas equivalents in other blockchains. So there is a cost that you need to evaluate when doing these things. And finally, what we call, what the industry known as miner extractable value, the fact that miners are sort of the ultimate point to commit a transaction to a specific blockchain in an HFT trade. So they have a say, and then you have to interact. Your strategies are highly dependent of the logic they use to mine transactions, to play transactions in a block. So there is some things like flashbots and things like that are trying to mitigate this, but it's definitely a factor that we should consider. The third point that I enumerated is the inefficiency of markets. And in crypto is I mean, just look at the market in the last 2 days. So in crypto, it's so common that we call it regularly inefficient. So there are many factors that cause inefficiency in crypto markets. One is the asymmetry of information. So people that are close to projects in crypto have a disproportional access to information that retail investors don't. In the current crypto ecosystem, news do move the market in a disproportional proportional way. There is a huge there is a huge gap in terms of arbitrage between centralized exchanges and decentralized exchanges, as well as arbitrage between different protocols in DeFi. And then the impact of what we call event-driven trades, like in the traditional markets, the equivalent to this would be mergers or acquisitions or a spin-off or massive news that could trigger a movement in a given security. In the case of crypto, things like token listings and things like that have a disproportional impact in the market. So some examples of this, for instance, Cardano recently have been, well, not so much recently, but let's say a week ago, have been experiencing a ton of momentum. And then the sentiment in Twitter is just crazy. Like, look at that, it's all green. And then look at the correlations with between the price movements, right, and the sentiment, which this is a Twitter sentiment is not a predictor of anything when it comes to trading. But just in the case of Cardano, like this example shows that the sentiment and the price, they're moving in tandem, which is insane. But that gives you an idea of how dependent crypto markets are on a specific social media trends. Then you have the examples of arbitrage. You just need to look across the existing DeFi protocols for borrowing and lending, and then you can see just crazy rates. Asymmetry, right? So there are trades that are just arbitrage in this scene, right? Borrowing in one, lending in another, and things like that. Then the fourth and final point I listed at the beginning is this idea of new forms of digital assets. So in traditional markets, you're building in an infrastructure, and then the new financial instruments, for the most part, are derivatives and structured products. Everything else remains very equal, very steady, right? You don't find new types of commodities and things like that very commonly. And then those derivatives, they do trade with certain basis on the underlying market. In crypto, because it's all programmable, it's all digital, we create new type of digital assets that trade in a disproportional way, that have nothing to do with the underlying crypto macro market. The canonical examples for this is NFTs. So non-fungible tokens is a classic form of digital assets that the dynamics for trading are really not the same dynamics that you used to trade Bitcoin and Ethereum and things like that. It's really focused on the scarcity, it's really focused on the collectors brand. It has a lot of dependency on the social media, on the listings and things like that. So the volume in NFTs recently has skyrocketed, and we have products such as NFT indices that are highly inefficient today. So there is a classic arbitrage on this of an arbitrage between the index and the underlying NFTs, of seeing when the index is mispriced. And because it's so inefficient, it's a trade that it works with a high level of certainty. And then the volume on these things is skyrocketing. So this is an analytic that shows sort of the OpenSea monthly volume, and you can see the ratio at which this is increasing. So trading NFTs is a market. So the NFTs are another source for quantitative strategies in crypto. It's not a pillow fight, it's not a game anymore. So there is a lot of alpha to be discovered in this space, but the principles for discovering alpha in NFTs are not the same principles for discovering assets in traditional discovering alpha in traditional crypto assets. Then I'm gonna take a second here for questions. So there are a couple. There is a question about how do you account for changes in a scale looking at historical data. I mean, yeah, this is more like a traditional question about quant strategy. So in time series data, right? Like the frequency of there could be area seasons and things like that could cause a lot of frequency. As the market grows, those frequent changes becomes more prevalent, and that's a pattern that you can see in traditional order books for crypto and things like that. So here there is nothing that is particularly different about crypto than any other asset classes. There is time series techniques that are optimized for dealing with this type of frequent change, and you can see those in time series forecasting models with machine learning and things like that. Not that the basic models like ARIMA and things like that, but more of the new sort of machine learning for time series model like deep AR and things like that. They build these capabilities as a native component. So for the next part of the session, I want to focus on, if you're building quant strategies in crypto today, what are some of the challenges that you're likely to encounter? There are many of those. So I enumerated 10 that I think are very common. One of those is small data sets. So in crypto, the data sets go back 12 years in the best case scenario, and a fraction of that in most common scenarios. So it's very difficult to train intelligent quant strategies with such a small data set compared to what you get in equities or commodities or any other asset class. Then this thing of regular outlier events. So market spikes, market crashes, and things like that happen all the time. I mean, they're so regular in crypto that has really, you can pick the most inefficient market that you can think in traditional capital markets that doesn't come even close. Why is this a problem? Because if you're training a quantitative strategy to make decisions based on a specific market patterns and almost very frequently encounters outlier events, that throws off everything that it has learned. So it's just very hard to achieve a good level of consistency with this. Then, for the lack of a better term, there is this challenge that we identified, that we named the regular retraining dilemma. That essentially it goes like this, right? If you're building a quant strategy in crypto based on a predictive models, those predictive models need to be trained, right? So you use some historical data, train the model to make a specific prediction. Now, what happened when there are outlier events, like I just mentioned, right? The price drops 10% and the model never seen that because it never has happened. Let's say that it drops 10, 20% in a few minutes. Then you have the challenge of, if you retrain the model immediately, you're prone to what is called overfitting, is that you're over optimizing for that scenario and making predictions are only valid what the pattern is there. But if you don't, then you're exposed to that to keep losing capital during that trade. So it's something that you don't experience in traditional quant strategies for traditional financial instruments, because most of those patterns are highly regular. So if you train a model in the S&P 500 for the last 5 years, you're very unlikely to find like crazy patterns on a regular basis. So you can retrain your models based on a schedule and all that, and you're going to be fine. Whether in crypto is very, very different. Then there are the issues of data quality and reliability. Data sets in crypto suck. For the most part, there is a lot of bad data with errors, with bad behavior, such as wash trading and spoofing and things like that. Then the fact blockchain data sets are a source of alpha, but obviously they're anonymous. So you need to spend a lot of time trying with anonymous, just looking at transactions and things like that. It's just really hard to extrapolate meaningful information. So you need to de-anonymize a lot of these blockchain records, which is a monumental effort in and of itself. Then this idea of the simple model fallacy, right? In crypto, in traditional quant, a lot of simple strategies work. Like a lot of most of quant finance today is not doing crazy deep learning or machine learning. Is very vanilla statistics and things like that. And a lot of those models, more or less, they sort of work. Crypto is just too inefficient for that. So those models, those simple models, will be very vulnerable to the inefficiencies of crypto. So everything indicates that deep learning, so models that can look at many inputs in order to extrapolate relationships between those, are likely to be more successful than vanilla statistical models. So for the last one of the last sections of this presentation, I would like to explore some cutting edge ideas that could influence quant strategies in crypto. The meta point here is that quant in crypto is sort of coinciding. It can take advantage of a renaissance in machine learning technologies that we're experiencing today. Is by far the machine learning is by far the hottest market in tech these days, and we're seeing an explosion of research and technology in that area, and a lot of that is making inroads into traditional quant finance, and obviously crypto is at the forefront of this. So there are different ideas that we think that are cutting edge on the machine learning side that we think are relevant for crypto. For instance, this idea of graph neural networks that's been around since the 90s. The idea of building neural networks that could work with graphical structures instead of more tabular structures, and this was computationally impossible to do a few years ago, but now it is. And you're seeing obviously a canonical use case for this is social media. So you're seeing companies like Facebook and Twitter throwing a ton of research behind graph convolutional models and things like that. And blockchains are fundamentally hierarchical. So you can model entire blockchains in a graph data structure. So graph neural networks have a place for doing this, for attacking this type of problems, particularly quant strategies, particularly for blockchain data sets. Another one that we're excited about is this idea of applying transformers to time series data sets. So there was a question about time series there at the beginning. So transformers is sort of the most revolutionary thing that has happened in deep learning in the last decade. Are the models behind Google Bird, GPT-3, and things like that that are changing doing massive breakthroughs in areas like natural language. Now computer vision, it seems to be the second domain in which transformer is sort of displacing traditional models. And there are efforts to applying transformers to time series data in as an alternative to traditional recurrent neural networks. So, and there is obviously the quant sector is being at the forefront of a lot of this research. So there are a lot of interesting ideas there. Then self-supervised learning is an idea that we think is very new. The main school for self-supervised learning is Facebook. So the Facebook AI research team has been the main lab pushing this idea, and self-supervised learning is rooted in this concept that how babies learn, right? Uh, Many people think that babies learn by just interacting with the world, but the fact is that babies have a cognitive notion about the world around them almost since they're born. Like they don't need to be trained, they don't need to interact with anything, they just know. So based on that idea of neuroscience, people at Facebook like Jan LeCun, that is one of the legends of artificial intelligence, have been pushing this type of models that could learn, that could be trained in massive amounts of unlabeled data. So you don't need to be labeling and classifying data sets. And they develop representations about an environment, and then you can fine tune the training. But the idea with that, it democratizes the training process. And because blockchains are all anonymous, right? That there is no labeled data other than the work that companies like IntoTheBlock do. It's really hard to train a model in labeled blockchain datasets. But what if you could use raw blockchain data as it is and have the models learn more? So that's an idea that we're intrigued by it. And then obviously the reinforcement learning, which it was the main lab behind reinforcement learning, and things like DeepMind and OpenAI. There have been a ton of breakthroughs and a million research papers published for finance, but really not many practical applications. So we think that there's some ideas, particularly in DeFi, that everything is visible or traits are visible. So you can start training reinforcement learning models are things that learn by trial and error. So they try something, they get a reward, and based on that reward, they perfect the actions. So you can think of reinforcement learning models that are looking at all sorts of DeFi traits and learning new things by just trying and getting rewards based on it. So to close this out, so some practical lessons about building quant strategies in crypto. So if you take everything that we have discussed and you're going to be building this type of strategies, what are some of the things that you need to look out for? So for instance, the simplest trades will work because crypto is so inefficient, right? Like you can have very basic strategies. That the most famous example of this, the basis trades with future, that doesn't work anywhere else. Well, it works in crypto, and you can earn a yield just on the futures curve. You need to assume that your data infrastructure is going to be very fragile. Exchanges are going to change, are going to fail. Coinbase is going to be offline when you need it. Data is going to be having gaps and stuff like that. Then many quant strategies, you don't need to reinvent the wheel. Crypto is different for quant, but many quant strategies for traditional market do work in crypto, particularly those that work with order books and derivatives and things like that. And also there is plenty of opportunities for new strategies. To summarize this and go to questions, crypto represents a new landscape for quant strategies. The market is really, really immature. And with that comes a ton of opportunities. When you think about DeFi, think of it as the next frontier for high frequency trading. When you think about NFTs from the quant perspective, think about it as a new type of asset class that doesn't trade based on the same dynamics as the underlying crypto infrastructure. And then there is a lot of stuff happening in deep learning that could have an impact in quant strategies for crypto. I'm gonna go to questions, but before that, I would like to announce our next webinar is about the analytics for Algorand. We're finally doing this release, and we have I don't know if the release will be ready by then, but we're gonna show you a ton of stuff. Our head of research, Lucas Otomoro, is gonna be covering that topic. The link is gonna be posted on the chat, so go register. It's gonna be awesome. I'm gonna go to questions, but if you want to contact me directly, I'm gonna be posting the slides on. Actually, the slides are in our Medium blog already. But you can contact me. You can drop me an email or contact me through my Medium post. I'm gonna stop sharing now to go to questions because I'm using a single monitor. So let's look at a few that we have here. Yeah, so there is a question, great question. How come Phantom with high returns did not catch any attention? No, it did. So Iman, so I was trying to not mention any specific blockchains and all that. We actually have a strategy for Phantom with protocols like Curve, and there is a ton. There is a ton of opportunities there. I just didn't want to get into any specific blockchains or protocols. What's the status of mining a statistic and its current trajectory? If you go to the existing IntoTheBlock, to the current IntoTheBlock analytics platform, you're going to find a ton of statistics for mining, indicators for mining for a lot of different blockchains. So not only Bitcoin and Ethereum, but a lot of different blockchains. So we did a lot of work on this and did a recent release, I think about 6-7 weeks. 6-7 weeks ago. Mark is asking if the webinar is going to be available. Yes, you need to go to our YouTube channel. It will be there. Then machine learning of deep learning, our model on a data set really trained. They're asking if machine learning and deep learning with the training cost could be profitable. Yes, absolutely. So machine learning is having is revolutionizing everything related to quant trading, just in traditional markets, and crypto is not the exception. We're gonna get to the point that a large percentage of the quant strategies executed in the market are gonna become intelligent, and that's where the game is gonna be. Today, supervised learning dominates, and you need to do a lot of training, and in the future, it will be forms of, let's say, lighter supervised forms. Mick is asking transformer models require a ton of data points, which is commonly not present when predicting the next price. Absolutely right. So what Mick is referring to is that this idea. So if you look at something like GPT-3, it has been trained in all Wikipedia. If you look at something like computer vision models with transformers, they have been pre-trained in millions or billions of unlabeled images. So it's a massive data set that you typically cannot find in a time series data set. So the research for time series or transformers is not so much on the pre-trained side, it's more on the attention side mix. So the transformers use this technique called self-attention or multi-headed attention that essentially allows you to look at, find all data points in a specific vector of a data set to look at each other. And looking at that pattern for time series has some interesting implications. So what I've seen for time series with transformer is more focus on that. There is a thing that Google published called the temporal future transformer. That is a transformer optimized for time series. That is quite interesting. The link for the next webinar is there. If there are no more questions, I would like to thank you very much for joining this webinar, and I hope to see you in the next one in 3 weeks. Thank you very much.